Hello, everyone. Welcome to Thoughts on the Run for the month of June 2026. My name is Alejandro Garza. I am the founder and chief investment officer for Aston Equity Management. We are a boutique investment management firm. We specialize in the small and mid-cap international equity space, but we do other things as well. And we have this little program or publishing event that we do every month that we call Thoughts on the Run. Then this is our edition for the month of June 2026. And we have two reports to review today. I encourage you to go to our website or websites, aslanem.com. And from there, you can also go to aslanetfs.com. But if you go to aslanem.com, go to the resources section, and there you'll be able to download the reports that we will be covering today. I encourage you to go to the website, download them. They're for download for free. We publish these reports every month at the beginning of the month. And so now this is for the month of June 2026, starting with our monthly market view and analysis. Several things going on in markets as we head to the final part of the first half of the year. We have the situation in Iran. Seems like it's evolving in a favorable way. At the very least, I think market participants are now considering it as a non-event, it seems. Obviously, that in terms of the geopolitics and the direct impact on global markets. But then, of course, there's the direct impact on energy prices, oil, and the direct impact on inflation. I think that's the big variable there. We've seen higher than expected prints on the inflation side in the US. And so maybe a few months ago, a couple of quarters ago, we were expecting rate cuts from the Fed. I think that now it's pretty much consensus that's not going to be the case. And if anything, we have a risk of inflation getting a little bit out of hand and hikes coming this second half of the year, 2026, maybe into the first part of 2027. And that is really the variable that could derail the really strong rally that we've seen driven by the AI trade, the so-called AI trade. But as you know, if you follow us and our work and our strategies, you don't need to be invested in what's hot at the moment. In this case, if you invest in a well-selected pool of small and mid-cap international equities, you can do really well, as we've done in our own Aslan strategies. So I'm going to go over the monthly market view report. Again, please go to the website, download the report. I'll be mentioning some of the slides that we have there. As always, we start with the historical market cycles where we show all the different bear markets. The average correction has been 29%. And 298 days in length. So always keep that in mind. These kind of bear markets come every 4 to 6 years. It's part of the nature of the markets. Valuations, I think it's important to consider that even though we are compared to the 20-year month average. If we look at the price to earnings ratio for the Standard & Poor's 500 index, for example, or if we look at global indices, and look at that same metric, where we are today compared to that 20-year average, we are significantly higher than average, a little above 1 standard deviation above average. So from that point of view, we could say that we are in a market that has significant downside risk. However, if you look at the fundamentals that sustain or don't sustain those valuations, in this case, if we look at the expected earnings per share growth for the next 12 months, we see that we are running right around 20% earnings growth. And that has been the case. It's an upward trend that has been ongoing since 2023, since the end of the pandemic and the inflation scare and interest rate hikes that we saw back then. We could say that that was the end of the previous cycle, the start of the current cycle. From that low point in earnings growth, which touched maybe 4% EPS growth in aggregate, we've been trending up and we're now at 20%. It's a very significant upward trend. And that's really what's sustaining the current market. And I'll jump around here in terms of the slides and the outlook that we're seeing, really. If you go to slide 28, with those valuation metrics in mind, in terms of the price to earnings ratio compared to the current level compared to the historical average, we look at slide 28 where the ROE is in terms of the different markets, USA, Europe, Asia, even emerging markets. It's very clear. We see an upward trend. So companies are getting a lot more efficient. They're producing a lot more capital per unit of capital input. So the historical average, again, for the 20 years, in the case of the return on equity metric, is right around 14%, 13% for global equity markets. The US has been trending from that average level some 18, 17 years ago to where we're sitting right now, which is right around 23% return on equity. With a 23% ROE, what you do is you double your capital. You know, because of the compounding effect, you double your capital every 4 years. So then the question is it reasonable to expect that same level of historical price to earnings ratio that we saw over the last 2 decades when ROEs were lower, where corporations were a lot less efficient in terms of their compounding ability? Or should we be looking at a premium because of that higher return on equity that we're seeing right now and trending higher? And so I think the conclusion is that we should expect this higher ROE resulting in higher price to earnings ratios. And if what we do in our monthly market view is we take what is known as the Fed stock valuation model, which is really just a measure of the corporate earnings yield compared with the fixed income risk-free yield, like the 10-year treasuries. You compare that difference, and based on, again, in this case, arbitrarily, we picked 20-year averages, last 20 years. What is the average? Where are we compared to that average? And if we only changed price in terms of the index, in the case of the S&P or global equity markets, if we only changed price, what is the change in price required in order to bring this back to the 20-year average, if you consider that to be the equilibrium? If we just do it with the price to earnings ratio or the earnings yield, we're looking at a 40% price correction required for the current market to come back to that kind of equilibrium level compared to the 20-year average. However, if you modify the analysis and use the return on equity instead of the earnings yield as the equilibrium metric, then what we see is a 13% upside for current conditions and the expected ROE going forward. So I think overall we are in a healthy market in terms of corporate earnings. Healthy because of the strength in earnings and because of the breadth of this situation. We're seeing this across the board, across global equity markets, across the different regions, and also across the different sectors. It's not only concentrated in tech, for example. It's really broad based. So it's a 13% upside that we see in terms of the equilibrium. If we use the modified, what I call the modified Fed stock valuation model, using the ROE instead of the earnings yield. Interestingly, the U.S. from this point of view, the U.S. equity market is a lot more attractive compared to international markets. As I mentioned, a 13% price upside compared to a 9% negative price downside for let's call it rest of the world. If you run the same kind of analysis. So return on equity, earnings growth, that's really what's driving this market. From that point of view, we're not in a bubble, at least in my opinion, in my view, and in my experience. Because the earnings are there, and earnings are still trending higher. But to be sure, what worries me is that this level in terms of earnings growth has never been sustained at such high levels for long periods of time. Again, if we look at the 20-year average, we're looking at 10%, 11% earnings per share growth. So as of now, we're twice that level, 21% earnings per share growth. Hard to tell if this time is different, if this time this will be sustained because of all the technological advancements that are being implemented at the corporate level, and that translates into corporate efficiency. That's one theory, one argument that we could say that this is sustainable going forward. But at least if we look at the 20-year data, these are like peaks that come and go in cycles. We've seen 3 cycles over the last 20 years. This would be the 4th cycle. So that's really what could be a bubble, the corporate earnings growth level that we're seeing. It's really strong and much higher than historical levels. And obviously the variable that could ruin everything for the global equity rally that we've seen is inflation. And then if it gets out of hand, rate hikes, and then that could induce a recession or a slowdown, and then corporate earnings come down back to more normal levels, 15, 12, 10%. We'll see later this month, this June, but so far the trends, at least in the US and Canada, North America, are not encouraging. We're seeing this spike in headline CPI, core CPI, and obviously energy is a big variable there. There are 2 really, and the good thing and the bad thing, depending on how you look at it, is these 2 variables have been induced, not necessarily organically driven. One is energy prices, as I mentioned, and that's a direct impact from the situation in Iran. And number 2, tariffs. Tariffs are inflationary. Tariffs in the US are basically an extra tax to the local economy. And so those two variables for sure are impacting this trend that we're seeing in higher inflation. We'll see if it gets out of hand as it is running right now. That is the single most concerning variable in our view for the equity outlook over the next 12 months. If we look at the yield curves, very normal still at this stage. We're not seeing any inversion yet. I think it's too early for that. Commodities, we've all seen gold, silver have been lagging this year after the strong rally we saw in 2025. In terms of currencies, some EM currencies having a very strong year against the dollar, which continues to weaken broadly speaking. The Brazilian real, the Russian ruble, Mexican peso, all these EM currencies strengthening compared with the dollar. We saw, if you remember last year, we were monitoring the dollar strength or weakness. We saw that overall it was like a 10% devaluation for the dollar against a basket of developed markets currencies last year. This year, sort of on the weaker side, but with a lot more stability in terms of the US dollar. And I would say finally, looking at relative valuations and expected returns. Relative valuations, what we've seen over the last 12 months is global equity markets catching up to the US lagging, and that is resulting in relative valuations that are less attractive for the rest of the world compared with the US in general. We can see that in Canada, we can see that in Australia. Europe in general is also kind of on right around average. Japan, to be sure, with the strong rally there, right now sitting at 1 standard deviation above the historical average. Again, when we talk about historical average in this context in our monthly market view and analysis, it's a 20-year period that we take. And even emerging markets have had a re-rating compared to the US. And so with that, and looking at all the fundamentals, and with our regression analysis, correlating fundamentals with expected returns, forward price to earnings, EPS growth, and return on equity, those three, and then the average will be a fourth. We come up with an expected return of right around 11% for the US over the next 12 months. And then for the rest of the world, we're looking at low single digit, between 1% and 5% expected returns in aggregate for total market, total equity market returns. If we look at specific variables, for example, EPS growth, in the case of the US, that model would signal a 20% expected return, quite strong returns based on that specific metric. In the case of the European Union or European equity markets, taken as a whole, 10% expected return, and then followed by Japan with 5.2% expected return. And finally, to round up the monthly market view, remember we cover our two indices, the Global Small and Mid Cap Index and the Nearshoring, North American Nearshoring Index. Both continue to do well. The Global SMID Index, created by Aslan, is up 14.5% year to date. A little over 2 percentage points above its benchmark. The benchmark from which it evaluates and selects the top 50 stocks within a pool of roughly 5,000 stocks. And since inception, it's running right around 16.6% annualized return. So keeping up with the original design, which was to beat the benchmark, its benchmark, by at least 2 to 3 percentage points per year, and we're right there at 3.36% of alpha generated or excess returns above the benchmark in case of the Aslan Global SMID Index. In case of the Aslan North American Nearshoring Index, last year we struggled with the way the index was originally constructed. We have since then introduced some enhancements, and those have worked really well. This year to date, I'm happy to report that as of the start of June, the index is up 45%. So really nice and strong performance, absolute and relative. And if we look at the broad market indices, which are up around 10%, 10, 11, 12%, we're showing very strong outperformance there for the year to date and since inception for the Aslan North American Nearshoring Index. That's the monthly market view, and which was the first part of the Thoughts on the Run for June. The second part is the monthly Aslan Quant Model Factors and Allocations report. Again, I encourage you to go to our website and download the report. It's published at the beginning of every month. And this is a summary of the Aslan proprietary quant model. What we do is we have a quant model that helps us. It's really the first step in our investment process. Helps us evaluate the investable universe, and we rank stocks from 1 to 5,000 in terms of relative attractiveness based on fundamental factors. And from the individual stock rankings, then we build from the bottom up aggregate factors, rankings, and allocations. In the case of the SMID to large cap allocation split, we are seeing an interesting trend by which the model is again increasing the allocation into SMIDs at the expense of large caps. We're right now running at around 79% SMID allocation, less than 20% large cap allocation, so very skewed towards the SMID part of the investable universe. Obviously, this is by design. It's an equally weighted or equally ranked portfolio. So every stock, independently from its market cap, has the same weight. So every stock will have its own independent score. There's just no additional weight assigned based on market caps. And so that will skew naturally the model to the SMID space. But I think it's interesting in terms of the work we do and the investment management work we do for our clients and for the firm itself. I think it's important to have this bias and this differentiation against the benchmarks, especially over the last 5 years, where we've seen this substantial increase in the mega caps and the very large and excessive, really overrepresentation in the indices. So I think it's an interesting start to the model allocation for the month of June. In terms of factor performance, It's really been an environment where momentum has prevailed. All the other fundamental factors like cash flow, growth, value, earnings revisions have been negative in terms of the factor returns. In terms of the regions within SMID, what we're seeing is an increase in developed Asia, stable Europe, and a relative decrease in North American exposures. North America being the US and Canada. In terms of sectors, I think what's most interesting, if you go to slide number 8 in the presentation, you'll see there a very clear bias towards cyclical sectors, energy, materials, consumer discretionary, with decreases in healthcare, real estate, utilities, industrials. Then if we move to the large cap model, liquidity has had a positive return in terms of factor. Momentum, similar situation as SMID's. I would say it's very similar in terms of the factor performance for large cap versus SMID cap, but I think a lot greater in terms of magnitude for the large cap model. Regions, stable in developed Asia, slight increase in Europe, and slight decrease in North America. For the sectors, again, very similar situation, but a lot stronger in terms of the energy exposure, for example. Here we have to be very careful, obviously. The model is picking up on the expected increase in earnings derived from the higher energy prices, but we know this is temporary, and so we look at this with a lot of caution. But still, I mean, it's very notable, the very significant increase in energy allocation, basically at the expense of financials, tech, and communication services. That's what we're seeing in terms of the quant model, the allocations, and the outlook for the month of June and for the second part of the year. This was Thoughts on the Run for the month of June 2026. Thank you, and see you next time.